All right, welcome everyone to the webinar. Efficient trade execution is critical for successful trading. Okay, first of all, I'd like to apologise. We were scheduled to have this webinar last week, but I was having some serious IT issues, which, you know, at the best of times, if you have any problems, you're off the air. Now, one thing that I would like to sort of point out to people is just how important it is to actually have good trade execution in your actual trading system. Okay, we've been sort of trading. I've been trading for 24 years across Sydney, London, New York, some of the biggest banks in the world. And one of the things they spent the first sort of about 5 years on was getting you up to speed on how to execute. And the next sort of 10 or 15 years, you're spending most of your time trying to work out how to get better at the execution. Okay, working out how to trade is the easy part. Working how to trade with clinical execution is the harder part, which you need to sort of spend a bit more time on. Okay, so just coming across now, I'm not going to sort of bore you either with this. This isn't going to be a lengthy process. I just want to go through the sort of general parts that you need to do and where it can actually take you if you do get good at execution. And when I'm sort of talking about good at execution, I'm talking good with good trade size, okay? It's very easy to trade with very small amounts, but when the execution becomes critical is when you're trading with larger sums of money. Now, your execution needs to be fast, efficient, precise, and absolutely without hesitation, okay? And this is the biggest stumbling block for new and experienced traders. As I said, this is the one area that the bankers spend a lot of time honing over many years, and this is what you need to be get up the curve on. Now, one thing, you know, I know most people know the general order types, but you should know exactly where they sort of fit in, how they operate, and when's the best time to use them. Okay, the market limit, stop entry, and OCO orders at the top there are basically entry orders. Okay, the ones down the bottom, the if done, take profit, stop loss, and trailing stop are all exit orders. Now they have a specific place to be used. If you don't know how to use them efficiently, okay, it's going to be like sort of dealing in the dark. Okay, you don't know what you're hitting and where you're hitting them, especially if you're trading live or with multiple pending orders as well. This can get very confusing and you can get lost very quickly. Now, just quickly to run through this sort of general setup. I mean, a market order itself is just trading live at market. Okay, this is probably the easiest and most efficient way for people to trade. Now, if you're looking to trade at live at market economic data releases, well then you're probably sort of clutching at straws because the market's going to be moving very quickly and you're probably more often than not get set. Now, if you're just using a simple MT4 setup, you can simply go to your MT4, click on the components here, double click, boom, boom, boom. As you can see, there's about 3 or 4 clicks here. It's actually quite cumbersome. We've got our own T-Rex system that we can actually sort of sit and just hit the trade that's actually on the market. You need to get something like this or deal with a system that has one-click trading, like C-Trader or a few of these other platforms that have one-click trading. You've got to have that up to speed. Now, pending limit orders, okay, this is a simple range trade strategy, okay? You should know and feel very comfortable in placing limit orders. You're going to be doing this a lot of the time, but actually understanding what you're doing, how to do it, get the right levels themselves, have contingent OCO, stop loss and take profit orders on the back of these, and actually understand how to put them on. You know, sometimes when you see an opportunity, you may only have, say, 30 seconds to put these orders on. Know exactly where to place the orders on MT4 or your actual other trading systems themselves. And this can actually sort of basically set you up to streamline your trading process. The more complicated you make the actual trading process itself, okay, the more emotional you'll get, and then things go bad from there. Using our T-Rex order manager, it's the same process. It's a little bit more simpler than MT4 that we found. That's the main reason why we set this thing up. Now, pending stop entry orders, the break trade strategy. Okay, this can be used for both trading technically around technical levels, as well as also trading economic data releases. And I'll come to that in a minute, because if you can get really good trade execution, I mean, when you're placing orders in the market around technical levels, it's like sitting in the library. It's very relaxing, very quiet. There's nothing to see or do. You just place the orders and they're in the market. But once you start trying to get a bit more functional and start trading some of these live trading events, that's where you can get unstuck with trade execution specifically. Once again, stop entry orders. If you've got the process and you understand how MT4 works, well, it's quite simple. At the same time, all these orders have an OCO contingent orders. Okay, so if any order gets triggered, we have another stop loss and a take profit to exit us out of those opportunities as well. Using our sort of T-Rex manager, as a few guys have got this, who've come through our training program. Once again, we sort of make it quite simple. Go up, select the buy stop. You have your stop loss and take profits attached to that, and then you're on. Okay. What that enables you to do, having this process enables you to place orders wherever you want to. Okay. If you don't understand which orders are for what areas, then you're going to have a bit of a hard time sort of trying to work out how to get into the market when it's most critical. One cancels the other. Just as quick explanation before I sort of move on from this part. These one cancels the other. Simple. If you take profit, well then you don't want your stop loss hanging around. Otherwise, if the currency came back down, you'd end up with an open position once again. And this is what used to happen in the old days in the banks when we used to use order tickets that were on paper and give them to humans. They were always making mistakes. But these computer systems, I mean, if you attach the orders to the OCO, as soon as one is triggered, the other one's cancelled. And that is a very big step in sort of making it easy for you to trade and not waste so much time in front of the computer. Okay, same thing. I'll just quickly run through the OCO setup here on our T-Rex order management. So basically, you stop loss and take profit, as I said. You have these things linked. When you go to sleep or when you're not at the computer, you can feel very comfortable. You're either going to take profit or get stopped out, and your capital is protected. The trading stop loss order. Okay, this is probably a little bit overused. I've seen by a lot of traders. They seem to get into a lot of positions and actually think, well, I'll just get in and run a trailing stop. Okay, I can tell you the currencies aren't really going on big one-way trends every other day of the week. Now, we saw a couple of good moves last week, but sterling sort of moved at 450 points. And Aussie a week or two before that went up about 300 or 400 points. They were the sort of best opportunities I've seen in a little while where a trailing stop loss would have been effective. Outside of that, if you're using trailing stops, well then you're probably going to get stopped out before the actual trade gets going because these things are, the currencies don't just go up and down in a straight line. But if you understand how to place a trailing stop loss in the orders, trade execution process can be a lot simpler and a lot more effective because you identify, for instance, one area where we would place a trailing stop is if we broke some daily trend lines, okay, some of the bigger trends, you place the order in, execute efficiently on the entry, and this is attached to the back end. That can actually make your execution much better. Now, one of the things with executing these orders and having the order management process, let me just go back to that, is actually understanding where to place the orders themselves in the market and how best to maximize the profit potential. Now, for you to potentially maximize your profit, the one thing that you really need to do is interfere less with your position. Okay, so having trailing stops and stop loss and take profit attached to all these orders is the smartest thing you can do because it stops you or stops the requirement for you to go back to the computer to close out the position. And so if you come back to the computer and start seeing yourself either up 10 or 15, 20 points, more often than not, you'll probably just take the cash. Okay, but if you know you've got those contingent OCL orders in the market itself, well, then that's where you can relax and just let the positions run. And that's where the real cash is, okay? Less interference, less time in front of the computer. Now, where you can really sort of take this to another level with efficient trade execution is actually trading the economic data releases themselves. Okay, this is an additional strategy you can have up your sleeve if you know how to execute clinically, fast, precise, without hesitation. But understand these events are high impacting, okay, extremely directional, which is exactly why we're looking for these events. But they are also, there's a higher risk component in there primarily because we don't know how variant the data is going to be once the release comes out. That's what I mean. If you've got a good execution system that can get you into these trades, well then you're in at the right levels and you're going to get out at the right levels as well. And that sort of lowers the whole risk profile of these sort of events. So what we have to understand is fundamentals, they do provide actionable trading opportunities. Okay? So if you know how to place those orders and why I sort of briefly went through, simple limit orders and pending stop entry orders and these things is because you need to know exactly that you can use those orders in the actual real market itself and get active like the traders at the banks. Okay, once you've assessed the market, you can actually start plotting the game plan. Bank traders are always looking to trade around these events. Technical traders look to avoid these events. Okay, if you don't have any experience in trade execution around these situations, well, then you're really sort of left behind and you cannot take advantage of these things. You know, the whole month, you know, there's about 60 events a month. There's only like 20 trading days a month, 20 to 22. Okay, you're looking at 2 or 3 events per day if you know how to get that clinical execution correct. Actual versus forecast is what it's all about. Okay, a stronger number. This is like, you know, child's play, I guess. A stronger number you buy, a weaker number you're looking to sell. If there's no variance in the actual numbers themselves, well, then there's no trade available. That's what you should be thinking. But this is where it gets a little bit more difficult, managing the variance after the event. As I said, we can look at the event and say, well, this is the number we're looking for. If we know if it comes out with different levels of variance, it may create a little bit of risk for us. So, but one of the key things you're looking at, the decisions you want to be making after this, if you do know how to execute, you'll be sitting back and just trying to work out whether you stay in the position, you add to the position, or you close the position out. Okay, I'll come back into some of these questions at the end. Now, trading economic data releases, 2 ways to trade: trading live at market or placing pending stop entry orders. The first one is a lower risk option. Okay, trading live at market, you have control of your position, whereas the placing pending stop entry orders, there's higher risk involved because you may experience, you know, a certain level of slippage if there is larger variance in the actual number. Okay, that's one of the biggest problems about trading these events. You actually have it, you know, before the actual, as the thing comes out, you don't even know what happened, and it's like just run over. Okay, so just looking at the 3 possible outcomes, you know, say we're looking at a weaker number here. You can have smaller variance, say like 0.3, medium variance minus 0.2, or larger variance minus 1.2%. Okay, there's 3 different scenarios here, and the currency will do 3 different things around those levels of variance. Now, if your execution is efficient, you'll know exactly what to do on these structure. So say, for instance, we had a small variance, and this is obviously not an ideal situation for us. Okay, the currency generally dips below an order. If you have a pending order in the market itself, okay, you're basically left holding a position out of the money, and at this point, there's nothing to do except probably square the position up. Now, it's one of the risks of trading these events. But if your, as I said, your execution on the platform is efficient, you can actually usually get away with these events with at worst case scenario, a small loss. If you do have a good setup, then using this sort of structure and execution, you can have get some medium variance. This is where the currency moves below and moves up or down in a very orderly fashion, goes through the levels, retraces back to where you got in, and then drops away. This is where efficient trade execution really comes back into play. This is what we're sort of looking for a lot of the times. And this is the same way you should be trading the technical levels as well. Large variance, once again, this is another sort of sticky situation where you can lose control of your risk. This is where understanding the trade execution process really comes into play. So when you're looking at some of these events, and some of them do come out extremely variant, okay, so what you can get is, you know, you place an order at, say, 30, for instance, and you get some gapping in the market. Your order's now down here at 15, is executed at 15. Your stop loss is now below sort of where the current market was before the event, okay, the key level. So your stop loss is at 101.40. You could actually, you know, it's like a rubber band being extended. The currency could shoot down, shoot back up, take your stop out, and leave you with a big dirty loss, okay? But if you understand what you're doing, there's a simple process here. What you would do is actually at 15, when it gets down, if you notice your order is executed away from your entry level, it's actually square the position up immediately, come back in, place a pending limit order back at 101.30, where your initial entry was, and then look for the retracement to get into the position. It's understanding the market and understanding how to place the orders quickly is where the answers are to sort of really being successful in this. Okay, so I'm not going to sort of just run through trading the live economic data without sort of telling you about the risks involved. Okay, there's a number of sort of risks, and you need to be, you know, very aware of yourself, your capital management, and your whole trade execution model. Okay, you've got to trade with control. you're planning for lower large variance, so you know what to do when the actual event happens. You've got to explicitly stick to your capital management system and stick to the plan of the trade. Okay, before these events actually occur, this is why where execution become extremely more efficient is knowing what to do when it happens and then execute efficiently. Okay, placing orders in the market is one thing, but when you have to close positions out and then tap in new positions or orders, that's where you have to be a lot more efficient. If you're losing, change strategies. Now, I wouldn't sort of say to anyone, just wait for these economic numbers to pop up and start trading them. This is an extra tool that you can use to take advantage of the market only if you have, efficient trade execution. Now, a lot of people get sort of bent out of shape who are having a bit of a trading event around these things. I know the first thing they do is blame the broker. But don't forget, this is the actual real market. This is how it works. Okay, there's sort of slippage and gapping in the real market every other day around these high impacting events. If you want to play this sort of structure, be aware that there's risks involved. At the same time, I can tell you there's a lot of money involved as well. A lot of easy cash to sort of tap into your account. So there's so many opportunities ahead here. What we have to do, this is where you should really be sort of looking at your order management, sort of thinking to yourself, now I'm not just sort of talking about trading live economic data events, I'm talking about trading technically and getting yourself prepared every day. Now, we've seen all the central banks, most of them drop their interest rates to basically close to zero. Okay? We're now in a period where they are going to be raising rates over the next sort of, whenever they start, maybe next 2015, for the next 3 or 4 or 5 years. It's going to be a delicate situation. Now, if you can get your trade execution to be extremely efficient, it's going to give you numerous opportunities here to take advantage of the sort of recovery phase of these global markets. Okay, I'm sure we're going to see a few knee-jerks where they raise rates, all of a sudden they're cutting rates again because the impact has been too dramatic on some of the economies. Now, one of the other things is with your execution, this sort of goes across multiple currency pairs. All right, if you're limiting yourself to just 1 or 2 currencies, well, then you're reducing your overall profitability significantly. You need to be able to sort of trade on each of these currencies, and with your execution, you need to sort of assess the general characteristics of each currency pair. They are all different. Okay, they behave differently. They've got different liquidity and ranges. You've got to understand that these currencies, the more you understand them, the better that you'll be able to execute in various currency pairs. Some are a little bit more volatile than others. Doesn't mean you don't trade them. We just change up the plan and change up the execution accordingly. So what do you need to be? You need to be a multi-dimensional trader. Okay, and this is where it really comes down to trade execution. Also understanding the technical fundamentals of the market. But if you can get this sort of dynamic in your trading, you're going to be on the way to being a very successful trader. Okay, so trading technically, fundamentally, with a specific structure, a set process, a precise trade plan, and most importantly, with stringent capital management. If you can get these components into your trading execution, then you're going to be give yourself every chance to be successful. Okay, so as I said, most people fall over on trade execution alone. So why do we need to be aware of the trade execution? Well, because the market's not always the same, and that will determine how we enter and exit the market. Okay, whether it's normal markets, choppy markets, which would be sort of considered more geopolitical issues, or extremely volatile markets, sort of more surrounding economic crisis. Okay, your trade execution needs to be adaptable to the dynamic nature of the market. If it's not, well, then you're probably going to be sort of running into trouble as things kick off. Now, the trading process itself, you need to have an entire trading process that is simple. Okay, it's a simple plan, and then that you can actually easily sort of put into play. Every time you sit in front of the computer, you should know exactly what you're doing. Okay, you're analysing the markets technically and fundamentally. You're looking at the best opportunities, general momentum of the currencies, and then it comes back to your plan. And your plan is all revolving around trade execution. As I said, most people sort of think it's all about trying to find things, and that's the execution where you fall over. I know a lot of people use demo accounts. Now, that's one of the worst things you could do, but where demo accounts can be quite handy is sitting there and actually practicing placing orders quickly into the market, so you can actually prepare yourself for potentially trading some of these live events, or actually just making split-second decisions, trading live and those sorts of things. If you don't have any sort of structure around that and any sort of skills, then when it comes to trading these events, you'll lose the plot and more often than not lose money. Okay, so there's a specific routine before every trade, precise analysis, specific plan, and last but not least, clinical execution. And what's that going to do? Well, it's going to eliminate the emotions you'll have and have you trading like a seasoned veteran. Now, these guys don't just trade, cold as cucumbers because they've been trading a long time. They may be a part of it because they've got more experience, but generally because they've got a plan and they know how to execute. Where you're going to get really bent out of shape and emotional in this trading and start chasing your money trade after trade is when you go to place trades and you miss the levels. Okay, then you think, the currency's still going my way. I better get back in or I better get out. Now, you've already missed your level. You get one chance at most of these opportunities to trade. If you miss the execution, then the trade's over. You start chasing them, it's just going to be a whole bunch of pain. So when your execution breaks down, what happens? Well, you actually break down yourself. As I was just saying, you start to get emotional. Okay, you start to question exactly what you're doing. Why am I spending 6 hours in front of the computer every day? Where are the currencies going? How am I supposed to get in? This is impossible. All these sorts of things that start building up until you start to sort of break down yourself. You'll have no control, no discipline, and you'll start executing wherever you think it's fun. Okay, this is where sort of trading goes from being like a good idea and sort of possibility to change your lifestyle and add value to your current financial situation to being a complete miserable experience where you just lost some of your savings that you could have used for somebody else, primarily because you just couldn't execute. Okay. Once again, I reckon it all comes back to the execution. So, when the old situation comes back to where's the money? Well, the money is in, having some understanding of the market and analysis. But what it all boils down to is actually having clinical execution. You don't believe that your execution is on the money at the right levels and at the right time. Then, if I put two trades against each other, one that could execute efficiently and another that sort of was just fumbling around with their orders, they could actually know, both of them know exactly what's going on, but one trader could actually make a lot of money, the other guy just lose his cash, primarily because they just can't help themselves with the clinical execution process. All right, and that's pretty much it. There's not too much to sort of really go through with the whole clinical execution thing. This is more something you need to build into your trading and get a better understanding of. Okay. Now, just a couple of questions here from a few of the guys. Okay, so this market is not that clear or predictable when news comes out. That's exactly right. So the market isn't clear or predictable. What needs to be clear and extremely certain is your levels of trade execution and the follow-up plan, the trade execution following the actual event as well. Okay, that's around these high impacting events. Now, if the high impacting events are sort of getting a little bit too much for you, then I wouldn't really encourage you to sort of get too involved in them. But if you're just trading technically, you need to get more efficient with your trade execution. Okay, not wasting valuable cash on making errors is a very important part to you sort of continually building your capital growth. Okay, so if you can't get this sort of into your whole profile, well then, you're going to basically be sort of falling over when it's most important. Okay, so that was sort of just meant to be very much to the point. Now, why I went through the simple orders at the very start there is because that's all you have to work with. Okay, those simple limit orders, the stop entry orders, these sort of orders themselves, they're the ones that you need to get better at. Now, if you think, oh, well, that's cool, I'm actually good at it, well, I'll ask you the question, I mean, how well have you been going lately? Okay, so if you want to maximize your real potential itself, you need to get really efficient at those and then start to look at some of these bigger events, some of the central bank announcements themselves, also some of the key economic data. That's where a lot more of the extra cash is sitting there. All right, let me just come back to see if I've got a few more questions there. Okay, so what do you mean by huge stops to compensate for efficient execution? I may have missed it in that one. So what you can actually have is sorry, just to come back to that there. So what do I mean by huge stops to compensate for efficient execution? What traders generally do, because they miss key levels, okay, they miss there's a clear executional level every time you go to trade. There's low risk, high entry, high probability trade levels. Now, if you miss one of those levels, that you may actually have to get into the currency at a different level because you've missed or you've fumbled around with the trade execution. So instead of like getting into the order where you've got low risk and say you've got a 25 or 30 point stop loss, what you can end up doing, having to trade sort of 10, 15, 20 points away from those levels to really to keep the position live, you're probably going to have to double your stop loss levels. Okay. So what you end up having is, as I said, if you know how to execute efficiently and at the right levels, then you can actually reduce your overall risk on the table. If you don't understand that, well then you're probably getting into the trades further away from the ideal levels themselves and having stop losses which are 2 to 3 times bigger than what you probably should really have. But because you trade away from the levels themselves, that's the sort of amount of risk you probably need to put in the market itself. Okay. Do you mostly trade around news events? Well, we do analyse the markets around these events. Okay, so it depends on the actual market. I should say it's more probably 50-50. Okay, that's the general sort of focus we've got. We're looking at these news events for specific direction, market bias. Okay, that's what we're sort of getting from. Now, some of these events themselves can be tradable opportunities, and we do take advantage of some of those, but not all of them. Okay, you don't sort of just go in sort of banging away on these numbers. You know, the execution models we've built are built around, specific clinical execution, and that's where you can take advantage of those opportunities. What time frames do the banks trade on? Well, they trade on hourly charts. Okay, so if you're looking at anything under an hour chart, you're looking at charts that no one in the wholesale market's looking at. Okay, you're basically trading by yourself. 92% of the volume is controlled by the wholesale market. So if you don't know what time frame they're dealing on, you're actually sort of flogging yourself, making it very hard for yourself. All right. Okay. Well, if there's no more questions there, guys. I mean, it was pretty, as I said, I didn't want this to be too long-winded. The idea was to sort of give you some general idea about, even though the orders set up on all the MT4s and other trading platforms are very simplistic, taking time to understand how to use them and place the orders efficiently, quickly, with clear understanding is going to be so much more beneficial for you, and it's extremely important for keeping you emotionally intact, okay, keeping your capital also intact as well, and keeping you sort of on the path to being successful as opposed to having hiccups around poor trade execution. Which time frame do you execute? Place stops. Okay, so when we say time frames, and I say an hourly time frame, that is the time frame forever. Okay, there's no like weekends. What time frame is more relevant for you and over weekends? Well, the markets aren't open on the weekends, but as I said, the time frames in your charts need to be probably an hourly bar charts. That's all you need to be looking at. So, sorry, I've just got the builder next door. Could you summarise the major components of trade execution? Is it just about placing the orders or what else? It is about placing the orders, but it's also about following the event itself as well. What you have to be ready with efficient trade execution, first thing is placing the orders. The second is actually being able to identify what's happening in the market, taking advantage of those opportunities when they arise, and understanding how to execute, maybe getting out or adding to the position. That's what you need to get really efficient with. So that's the first part is placing the orders. The second is following up and either exiting or adding to the positions with clinical execution when you see something happening. Yeah, okay. The Greg Furman to all attendees, this is just noise. That is it. Okay, well that's interesting, Greg. I've got to say that after 24 years in banks, all I look at is the news. It is the direction. If you're looking for anything, if you're trying to work out any day if currencies are going up or down, it always comes back to the actual news, because that's what gives the currency direction. If you're trading with technical analysis alone, you're just going to flog yourself to death. Okay? It's going to be a slow, miserable death, and you'll end up with no cash in your account. And that's actually from a lot of experience. So, if you think it's noise, well then, so be it. Good luck with that. Do they hold trades overnight and weekends? Not generally. Okay, so most of the traders don't hold positions over the weekend. The big macro funds don't have a choice. They do hold them. But there's a lot of event risk, terrorism these days, natural disasters, G20s, any sort of thing can come out the weekend. If you're running positions over the weekends, you are running a huge amount of risk on the open of trading on Monday. Can the banks control the market? Well, I guess for snapshots, they can if they've got enough flow. If they've got enough flow at any specific time, they sort of can control it a bit. But overall, the market's too big for anyone for the bank to be controlling it, for any significant amount of time. But is it not true that most people trading that new do not know what it means causing the price swings? I think most people don't understand the price swings. I think people don't understand the impact that the news has and how important it is. This is where, if you understand, as I said, like sitting back and just being able to place pending orders is one thing. If you're looking to trade live and have, critical execution when you see specific opportunities, that's where the real traders are. That's what a real FX trader is, being able to adapt and trade live around these key events. Would you agree that the news is only a trigger for what the market is going to do? Well, not really, mate. No. It is a trigger for what they're going to do, because that's actually, well, you answered the question there. The news is the trigger that actually gets traders to do what they're doing. Okay? Now, if you get, say, 2 or 3 news events in a row that are all, say, positive, well, the currency's already going up, so that's why it is going up in the first place. So the market, okay, so for instance, the market's going down, I'll give you a bit of an example, okay, and the news comes out extremely strong. So is it something that the market's going to do anyway? No, if the market's going down, it's going down. If there's fresh news in the market, well, everyone will be buying, and that's what's going to happen. And they're only buying for that event, nothing else, okay? So you're sort of getting lost in translation here, what the actual news is for. It's about market sentiment. It's about market bias, which direction currencies are going in. Now, the news, this is actually not a bad point. As in, the news doesn't decide direction, but only operator. Well, what does, Rev, can you tell me what does determine direction of the currencies? Do you think it's just an accelerator? What does determine the direction of the currencies? Do I trade non-farm payrolls? I've probably traded the last 12 months. They are a vicious, nasty bit of gear, the old non-farm payrolls. I wouldn't be sort of expecting anyone to get into the non-farm payrolls. This is the thing. We don't go trading just random news events or look for the big cranky ones. Having good trade execution is also understanding when to trade and when not to, okay? The non-farm payrolls is a bit of a bloodbath. I wouldn't be encouraging anyone to actually trade those events. I know people who like to beat their chest and sort of say, I've been trading for so long, I trade the non-farm payrolls. Well, I can tell you, being smart is actually, avoiding sort of events that are actually a bit of a bloodbath. Trev, mate, come on, tell me what determines the currency direction. Okay, so I heard the outcome of news already priced in by the big banks, and the news is the trigger. Well, of course, the news is priced in. Okay, so when the news comes out, if it's variant from the forecast, that's why the currencies move. Okay, so the banks are always pricing in everything from geopolitical situations to economic events. These are all in there, but if there's any sort of variance in the actual release from the actual what's been factored into the market, that's where the currencies move to. Right, okay, it's been an interesting little session. All right, so the idea of this was to just sort of highlight and bring to the forefront the potentials or where the efficient trade execution can really come in and be a major part of your actual success. Okay, I can tell you, as I said, getting into the currencies at specific levels you want can be very important and be a critical factor in you getting more successful in the market itself. All right. Okay, great. Thanks, everyone. Thanks for joining us. It's been an enjoyable session once again, and we look forward to joining you again next time.